Giles, thanks for joining us. Perhaps it'd be useful to begin just telling us a little bit of background to yourself and also about Vivo Energy.
Thanks, Elliot, and great to be here today. My name is Giles Blackham. I'm Head of Investor Relations at Vivo Energy. I joined just under 3 years ago, shortly after the business listed on the London Stock Exchange and also had a secondary listing on the Johannesburg Stock Exchange. And we're now a FTSE 250 business, around £1.4 billion market cap. And the business was actually formed just under 10 years ago through the carve-out of Shell's African fuel distribution business. And since that point, we bought 15 countries from Shell, or operations in 15 countries from Shell, with around 1,200 forecourts or retail sites and a range of commercial customers as well. And since that time, we've really focused on growing the business and making sure that we service the customers as well we can in growing markets. And so we're now operating across 23 different countries with just over 2,300 forecourts across those markets. So to give you an idea of scale, we sell around 10 billion litres of fuel each year. It's a combination of fuel, LPG, lubricants, and a range of products. And we serve around 750,000 people a day. We're a market leader in most of our big countries. It's a highly cash generative business, and just before the pandemic, we made just over $400 million of EBITDA. And over the last 5 years, have made free cash flow on average of about $180 million, with very strong returns, and our return on capital employed of over 20% per year. So we think it's a very strong business, a lot of opportunity to grow in growing markets in Africa. There is an increasing demand for fuel as the countries we operate in develop, and we think we're well placed to capitalise on that going forward.
Great. And how much of the business comes from retail, commercial, and lubricants?
The majority of our business is in retail, so selling on the forecourt. So that's about 60% of our EBITDA. Slightly less volume, but it's a slightly higher margin business for us. So as I said, we operate under the Shell brand in 15 of those countries, and we actually operate under an African brand called Engen in another 8 markets, and that's something that joined our portfolio in March 19, and we think there's a real opportunity to grow the networks in those markets. The commercial business is something that we sell fuel to a range of industries, so mining, aviation and marine, which clearly at the moment is relatively limited, but agriculture, industry, and then we also sell LPG in canisters, both to industry but also to the consumer. And that commercial business is about 45% of our volume, but slightly lower than that in terms of EBITDA, as it's a lower margin business. And then the final piece of the pie is lubricants, which is a very low volume business compared to the others. So we sell just over 130 million litres of lubricants out of that 10 billion litres. But because the margins there are very high, it's kind of a fast moving consumer good. The margins there are 10 times what we have in the commercial business. So it's a very valuable part of our portfolio.
Great. And how has COVID impacted the business over the last 12 months?
Well, I think like any company, it's had a pretty big impact. And we sell into people who have to move. Mobility is a core part of our business. So when COVID hit, what happened in many of our markets in Africa is that we saw mobility drop. Governments, as you would expect, were very nervous about the impact of COVID, so acted very quickly and actually locked down about the same time as the UK did last year, end of March last year. So we saw a major impact in Q2 as volumes dropped about 40% as our consumers stayed home and a number of industries stopped. But I think in part due to that quick action, but also, I guess, the demographics potentially within Africa, we haven't seen the same kind of health impact that we saw in this country, in the UK, and in other developed markets. And actually, it's been relatively limited to date. And what that's meant is that there's been a pretty rapid reopening of our markets. So what we saw in June was the volumes were back to being less than 10% below the previous year. And they've continued to be around kind of 5 to 10% below the previous year through H2, as there were some restrictions maintained. So there are still social distancing, borders are generally closed, and we have curfews in a number of our countries. So we are not quite back to normal, but we did see a kind of a major impact in Q2 and then I guess a pretty swift recovery. As we've gone through into Q1, what we've seen was our retail business has actually returned to growth. So we were higher in Q1 21 than we were in Q1 20. And that's in part due to continuing to roll out the growth of the network. So we added 100 new sites to the network last year, even with all the disruption from COVID. And as we go forward, we expect to see the markets will have some restrictions. We won't be back to normal for some time, but they will be generally lighter than we have seen in the UK, as a real lives versus livelihoods debate going on in these markets. So people are trying to look, governments are trying to learn to adapt to keep their markets open whilst keeping their people as safe as possible.
Okay, and what are the main external influences on the business, and are you exposed to the oil price?
Yeah, so it's a good question. It's probably the one that we get asked most, is surely as a company that sells carbon products or oil products, you must have some exposure to the oil price. So as the oil price goes higher, it must impact your margins. The reality is it doesn't. We are a cost plus business. So in the vast majority of our markets, they're regulated by the government. So we're allocated a fixed amount per litre of margin. And so we don't really mind whether the oil price is $30 or $80. We still make the same amount of money. So it really is all about the growth and how much volume we can sell. So the oil price really not a big factor for us in ordinary times. What really matters to us is GDP growth and consumer spending, and the underlying demand which drives the underlying demand for fuel. So what we've seen in these markets, in these 23 African markets, is that they are high growth markets. I think coming out of the back of COVID, we're expecting the markets to grow on average about 5% a year between 2022 and 2025. And what we see is fuel demand generally grows about 75% of that, so 3.5% to 4% growth per year. And what that means for us is that we hope to capture at least that and generally grow our market share as well. So we should grow faster than the market growth, but it also provides a lot of operating leverage within our business. So we don't need to add significant cost to capture that demand growth. So when you see volumes growing at broadly 5% a year, you see a much higher kind of impact on the bottom line, both EBITDA and then EPS. So the other question that we get asked a lot about is the transition and climate change, and it's something that we as a business are preparing for and doing a lot of thinking around. But on the ground, the impact is today very limited. In part, our markets are really developing countries. They don't have the infrastructure set up just to provide electricity, generally reliable electricity across the countries. Cost of electric vehicles is very high. So it's something that today we see very little impact in the majority of our markets. We are preparing those, so we're evolving our customer offering. We're increasing the non-fuel retail on our sites and making them destinations. We're offering more and more transition fuels, such as LPG and other liquefied gases, which are cleaner than traditional kind of heavy fuel oil, which is used for industrial purposes. And we've made our first steps into solar offerings for our customers. So for our big industrial customers, we now offer a hybrid power solution where they can run let's say their mine on solar during the day and on fuel at night. So it both saves them cost, but also emissions. So something we're hoping to roll out over the coming years. But certainly in the medium term, we don't see this as a major threat to demand growth in our markets, just because of the underlying demographic growth we see within it.
And what would you say makes Vivo Energy stand out from its competitors?
So I think we've made a lot of changes in the last 10 years from what was a relatively centralized business that was quite slow to act. And what we did was change the culture and really made it focus, simplify, and perform. Kind of three key tenets to that. So we cut out all of the unnecessary chaff within the business so we can react quickly. We can move faster than what we believe the competition will do. And we really saw that through COVID, that we could react to very changing conditions on the ground to support our customers, our people, and our communities. We've also decentralized the business significantly. So our local teams are empowered. They are held responsible for their business plans, and they're held accountable and ultimately rewarded for that. So we feel that is a much better way of running the business, with the appropriate governance oversight, clearly, but this is a very local business. You need to be close to the customer, and the way we run our business now means that we are, and that helps, again, move faster than other people. I think in terms of the broader market, though, what also makes us really stand out is the brand. So, as I said earlier, we operate in regulated markets in the main, so we don't compete on price. So if you're, as a consumer, you don't have to worry about you paying more for the Shell brand. You'll pay the same amount whether you're going to a local player or the Shell sites. But at Shell, you can guarantee that you're going to get high quality fuels. You're going to get the same quantity of fuel that you've paid for. It's going to be a safe environment. You're going to get very good customer service, and you're going to have an additional offering, whether you want to buy a coffee or a burger or something else. So all of that together means that we really drive volumes at our sites, and our average throughputs are the highest in the industry. And we actually see, when we rebrand a local player to a Shell brand, we can see a 20% plus increase in our volumes when that happens. So it really shows that we can continue to grow market share and have a really strong position in these markets.
Great. And how does the company go about allocating capital?
So this is really a growth company still. So we operate in growth markets, and we believe that we can grow with that. So we have about $150 million a year of capex that we spend, and around 100 million of that is growing our business. All of that capex is self-funded, so we don't need external capital to grow. This is, as I said earlier, a very highly cash generative business. So it's self-funded by each of our local companies. That $100 million guides you about 100 new sites a year on a net basis. So actually we open slightly more than that every year. And it means we can continue to grow invest quite heavily into our non-fuel offerings. So we've worked hard to expand restaurants on site, shops on site, and the other offerings to, again, increase the attractiveness and the offering that we can provide to our customers. We also then invest in offerings on the commercial side, whether that's new cylinders for the LPG and sometimes from bigger infrastructure projects for our mining customers. So we can expect that growth rate, certainly the 100 new sites a year, is something we can see going forward over the medium term. But even with all that investment, that we still have capital ahead of that. So we do also pay a dividend. We started out with a 30% payout ratio when we listed the business 3 years ago, and we saw that step up pre-COVID. We actually paused the dividend during COVID because of the uncertainty created, as you would expect, and we're being very prudent at that point in time. But then as we get into the second half of the year, we caught up that dividend payment through an interim dividend, and then we actually subsequently maintained our progressive policy and paid a dividend for the full year 2020. We've now also then increased our dividend payout to 50% of EPS going forward, which today equates to a 4 or 5% yield, depending on the year you're looking at. So that, together with a pretty strong financial growth, hopefully is important for our shareholders.
Great. And perhaps you'd like to end the interview just by concluding on maybe why investors should take a closer look at Vivo Energy.
Thanks, Elliot. Yeah, look, this is really an African consumer staple that's exposed to long-term positive demand trends. We've seen demand is inelastic to the oil price, and that when COVID restrictions are released, but demand comes back very quickly. And we think that long-term growth is there, underpinned by growing GDP, growing populations, and increasing consumer spending in our markets. And we are really central to that growth across the continent. So we will see this as a compounding growth business. I think it's also important to note we are really focused on sustainability. It's integrated into our business. So we have very strong governance and oversight of the business. We look after our people. We develop them through the organization. Given where we operate, we work very closely with governments and communities to help development there. So it's a critical part of our business, is making sure we do the right thing and help develop the continent. So I think finally, this is a self-funded compounding growth business with really strong prospects going forward and a very healthy dividend yield at the same time. So something that I'm very excited about going forward.
Fantastic. Giles, thanks very much for your time.
Pleasure. Thanks, Elliot.